Hello everyone, it's Steve with Aptera Owners Club. In this video, I want to talk a little bit about a Silicon Valley Bank because that accelerated pretty rapidly here. So early this morning, actually yesterday, which was Thursday when I'm recording it, we'd heard that Silicon Valley Bank was in a little bit of trouble. They had announced that they had liquidated all their easily liquidable assets and were looking to raise another 2 billion to stay solvent. Their stock dropped by 60% on Thursday. And then this morning, Friday morning, there was a rash of news articles in the financial press about what is the likely outcome here and what was going to happen to Silicon Valley Bank. Some venture capitalist firms were telling their startups to pull money out. Others were telling their startups to leave money in because pulling out would start a bank run and it would hurt everybody essentially. And these were some of the quotes that some of the things that people were tweeting about and saying about Silicon Valley Bank. Michael Burry was saying that he thought that maybe they'd found their end run of this era. Bill Ackerman was saying that there was going to be a bank run and risk of failure and deposit losses, and he thought maybe government intervention should happen. And then Scott Melker, who's a podcast of a financial podcast, said that they bank a huge swath of the tech industry and large venture capitals. This is an extinction level event. Well, as it turns out, they were shut down by the SEC just today, later on today. And let's see, this is the Federal Reserve's most current table of assets of major US banks. And this was shocking to me for a couple of reasons. One is, wow, the amount of money that JP Morgan, Bank of America, Citibank, and Wells Fargo control is amazing. It is JP Morgan Chase controls $3.2 trillion. Bank of America has $2.4 trillion. So these are trillions of dollars. That is crazy. And here it is. At 16 is Silicon Valley Bank. So it is the 16th largest bank in the United States. So it's a very big bank. It controlled $209 billion. That's at the end of December. I believe this table is updated on a quarterly basis, so they were about to update it again at the end of this month. But it did collapse, and there were a couple of people talking about why it collapsed. And one, people think that they weren't regulated. So I guess there's these two things called the liquidity coverage ratio and the net stable funding ratio. Basically, from what I understand of it, it's basically the regulators say that you have to have a certain amount of assets that are easily liquidable so that you can stay solvent in the case of a downturn. And usually it's about 30 days of funding. So they have these rules called NSFR and LCR, and evidently SVP, Silicon Valley Bank, did not have to follow any of these rules. And this is what they say in their most recent 10-K filing. It says, as a banking organization, our liquidity is subject to supervision by our banking regulators because we are a Category 4 firm with less than $250 billion in average total consolidated assets, less than $50 billion in average weighted short-term wholesale funding, and less than $75 billion in cross-jurisdictional activity. We currently are not subject to the Federal Reserve's LCR or NSFR requirements, either on a full or reduced basis. So yeah, there are these requirements for larger banks, and they were just under the threshold for being regulated in that manner. So they did not have to keep any of these assets to keep themselves running for about 30 days. And that has come back to bite them in the butt. And this Economist article, I think, explained the situation the best. I think the Economist is like a really great place to go for information. They have so many good articles. I think my two favorite are probably The Economist and The Atlantic. But anyways, here's their take on the whole thing. So the first thing to know is SVP, Silicon Valley Bank's been around for almost 40 years, and they basically are the banker for more than 50% of the startups that are VC backed especially around Silicon Valley. So the whole venture capital startup ecosystem, the dominant player is Silicon Valley Bank, especially in Silicon Valley. So I don't know if Aptera is banking with SVP or not. My guess is they're not. They seem to be very like San Diego focused. So I think that they probably did not bank with them, but there's a decent chance because they do bank about 50% of the startups. But anyways, what happened is that there was a huge boom in venture capital funding, and startups were flush with money. And so what happened is their deposits, since the startups are banking with Silicon Valley Bank, their deposits went from 44 billion at the end of 2017 to 190 billion at the end of 2021, but their loan book only went from 23 billion to 66 billion. So you see in 2017, they were loaning out 50% of their deposits, and in 2021, they're only loaning out about 30% of their deposits. So that's not good for them because they make money on this spread. And so they wanted to acquire other things to like make them money because they weren't making money loaning as much. So what they did is they went into mortgage bonds and treasuries. And then what happened was inflation happened. And so then interest rates went up. And so they bought treasuries and mortgage bonds when the interest rates were low. So now their treasuries and mortgage bonds are worth a lot less, which left them really in a hole. And so that's how they got into the financial problems that they're in. So if they had followed the rules and had been regulated, they couldn't have put as much into these mortgage-backed bonds and treasuries, because these aren't as liquid and probably, I guess, too risky or something. Although treasuries are fairly safe in terms of retaining your principal, I believe. But because now the new treasuries have a higher interest rate, the old treasuries with lower interest rates are worth less. Okay, so anyways, a bunch of venture capitalists told their clients to pull out. They started pulling out. There was a bank run. Today, the stock dropped by another 70%, and then they had to stop trading on it because it dropped 70%, and that starts a new that triggers a stop on them. So they've now shut down. And so what's going to happen? So they talked to this guy, Mark Sester. I don't know who he is, but this sounded pretty intelligent. So his startup has a relationship with them. His venture capital firm has a relationship with them, and so he banks with them. And what's happening now is that, so he said, I heard that 12 billion exited from SVP yesterday. They have a little under 200 billion assets, so it's about 6 to 7% of their assets left in a day. That's not catastrophic, but the Fed basically saw that it was going to. Sorry, so it's the Fed that shut them down. Sorry, not the SEC. The SEC is more of a watchdog group. So the Fed basically shut them down, and they knew that it was going to be a bank run, and so they stopped it before it became a full-on bank run. And what's probably happening is the Fed is shopping around SVP to bigger banks to see if anyone wants to buy them out. And it is very likely that someone's going to buy them out. And what's going to happen is those people who are stockholders in SVP are going to get wiped out. Well, they already got wiped out. It dropped 60% one day and 70% the next day. But they're probably going to get completely wiped out. And those people that have a lot of equity in SVP are not going to do well, but they feel like the deposits are going to be okay. It's just going to take about a week to figure that out. So people that are banking with them and have deposits, they are probably going to be okay, according to what this guy is saying. And it seems to make sense to me. All right. So this basically tells you the financial headwinds that Aptera is facing, unfortunately. So it used to be really good. If you look at this graph, this is a graph of the venture capital investment over time. So you see in 2020 and 2021, and this is around the time Aptera started. So you saw like their funding was super easy. Capital was very easy to come by. and now it's like dropping off like a cliff ever since the beginning of 2022. And if you, it's kind of funny because if you look at this graph, it's very similar to the graph of the stock price of Silicon Valley Bank. You see, like it started climbing in like late 20, and it starts dropping off in early 2021. So it's very similar. So this venture capital um, funding graph very similarly matches the funding graph of Silicon Valley Bank. And of course, Silicon Valley Bank dropped off like a cliff here, and hopefully, venture capital investment isn't dropping off like a cliff. But what's happened is the economy has not done well, and therefore a lot of the venture capitalists cannot find funding, and they get funding from like family offices and like university endowments and things like that. And they're all those pension funds and university endowments and family offices are just growing nervous and stingy, and so they're not looking to back startups. People are looking for security right now, and startups are not security. And this failure of Silicon Valley Bank kind of highlights the problem with in the venture capital startup marketplace right now. It's just a tough place to be. So hopefully Aptera was not banking with them, and my guess is they're not. But it just the financial situation isn't getting any better for startups. It's probably getting worse after this SVB bank, which is why I think it's a good thing that Aptera is mainly looking to the Middle East, Europe, and India to find their big backers. But then again, if you read the articles, that's where everyone is headed. Everyone is headed to the Middle East and to look for capital. And it used to be the Middle East was a relatively easy place to get capital, but now that they have so many people going to them, they are becoming more conscious and being more picky about who they back. And so that market has also gotten a little harder. Okay, well, if you guys understand this any better, please let us know in the comments below. I thought it was fascinating reading about how this worked out, and I would definitely read the Economist articles. I'll link them in the description below. They're very interesting. All right, thanks for watching, guys. Thanks as always to our supporting members. Have a great weekend.